Here's a crazy fact that I came across recently. There are thousands of people today in the UK who are on an Islamic mortgage who are paying hundreds of pounds more than they should be, and they're doing nothing about it. How do they avoid that? Simple, by remortgaging. So I started looking into this area because I recently remortgaged my own property for the first time. So I looked into this fully, and I'll be sharing with you in this video my 6 top tips that will end up saving you thousands of pounds. But first, let's actually explain what exactly is remortgaging. An Islamic mortgage, also known as a home purchase plan or home financing, is a way to pay for your home over a longer period of time. You will typically enter into a 2, 3, 5, or sometimes even a 10-year fixed term with your provider and pay a set monthly rate to them over that period. Now, a remortgage is what happens when that fixed term ends, because of course your mortgage is still there, you've not paid out for your house, so you need to renegotiate and effectively get into your next term, whichever mortgage provider you're going to enter into. Just like with your car insurance company, if you do nothing, then your current mortgage will revert to what is called their standard variable rate. And just like when you are dealing with a car insurance company, you don't want to be going back to their standard because it will be a lot more expensive. And that variable rate today stands at 8% per annum for most Islamic banks. So just like you remember to renew your car insurance for the next year and don't let it default, the same applies with Islamic mortgages. You should consider remortgaging and entering into a new fixed term mortgage, either with your current provider or shop around and potentially find another provider. And that way you will save a big hike in your monthly expenses that will otherwise come automatically. So now we've understood what remortgages actually are, let's get into the tips. So the very first thing you should do when your term is coming up for expiry is actually consider all of your options. A remarkable number of people hate finances and money-related admin so much, I can't understand why they would be like that. I mean, I love this stuff. They will literally end up paying thousands more over the years because they don't want to face into this life admin. I mean, come on guys, it's worth it for a few £1,000s. It's often the case that your current provider is where you will end up staying, because if you stick with your current provider, you will only pay about £200-300 more for the admin and the paperwork, and then you're done because you're already on their system. But if you do switch, you will have to pay for redemption fees with your current provider, legal fees of your new provider, upfront product fees, surveying costs, etc., etc. But I actually ultimately ended up switching away from Gatehouse to StrideUp, as at the time they were offering a competitive rate, and I personally also wanted to support them as an Islamic fintech that is much more community oriented, and I didn't necessarily lose out financially, so I wanted to do that. All in all, the switch actually ended up costing me about $4,600 in legal fees and product fees, but because of the competitive rate that I got, the whole thing kind of smoothed out and I didn't ultimately end up losing any money. Now, by the way, I had a chat with them and I got a few of these expenses knocked off or trimmed down a little bit. So it is definitely worth that chat with your mortgage provider too. And it depends where these mortgage providers are in their business cycle, because sometimes they're really keen to onboard customers and will give you great incentives, while other times they don't really want to get new customers on board, and so they won't give you as sweet a deal. The choice that will present itself to you from all Islamic finance providers will be, do you want to get a 2-year or a 3-year or a 5-year fixed rate term? Or do you want something floating instead? Something that will be pegged to what is called the Bank of England base rate, the interest rate. And look, of course, Islamic mortgages don't deal in interest, but unfortunately, interest rates are set by central banks and are so fundamental to our modern financial system that whenever they change it, it will actually affect Islamic mortgages too, because that's how the entire market is priced. Either indirectly or directly, therefore, we are affected by whatever the Bank of England says. So if you think interest rates will go up in the next few years, then you want to be locking in the rate you are getting now so that your payment doesn't go up even if the interest rates start to rise. But if you think interest rates will go down, then you want to lock yourself in for as shorter term as possible so that you can remortgage again in a couple of years' time when the rates have dropped quite a bit. And then you can just switch over to a lower rate product. So let's take a practical look at the Gatehouse Bank website. So what this is telling you is that Gatehouse offers you a 2-year and a 5-year fixed term mortgage at various different finance to values, which is basically how much of a deposit you are going to be putting towards the purchase. So right now, my assessment is that interest rates are likely to remain high, but start falling over the next couple of years. The IMF have said that the UK should be targeting 3.5% by the end of 2025. Now, we don't know if that will happen, but using that as a yardstick, you can see that rates are going to fall, but they're not going to fall anytime soon. So I would lock in personally for a short term a period as I could, in the hope that by the time that I return back to the market to do my next remortgaging, the rates have dropped so much that I go on to a much better rate. So I ended up saving hundreds of pounds by doing this one thing, asking Gatehouse to revalue my house. Because you see, if I hadn't asked them, Gatehouse were just going to roll me over on their 80% finance to value product, which was more expensive. But once I asked them, they rather sheepishly agreed to get a survey done, which valued my house nearly £100,000 more. And this then meant that I had a much larger equity in the house, which now meant that I had access to their cheaper product, i.e. their 65% finance to value product. Because now, effectively, I had more of a chunk of the house that I owned. And so the more of a chunk of the house that you own, the cheaper your rent is. And so that meant I got a cheaper rate as a result of that. So always get a survey done, especially if you think the house price has increased substantially. In my case, I had saved up some money separately, and once the property valuation came through, I realized that I was pretty much there at the 65% threshold, but I hadn't quite got there. So what I did was I put in a few £1,000s extra into the house to bring myself fully over the 65% threshold and get the more attractive rates it comes with. And right now, by the way, with mortgage rates being so expensive, it actually makes a lot of sense to put more money into your house, as for every pound that you put in, you are saving yourself from paying around 6% cost on that amount per annum. Sure, you could invest that money, but then you would need to be darn well confident that you would make back more than just 6% that you would otherwise be saving by putting it into your house. As part of my research for this video, I actually spoke to Saqib, who's a CEO at StrideUp, and he was explaining to me that there are still several thousand people with legacy HSBC Amana mortgages and Al Buraq mortgages, and they haven't remortgaged in years. And as a result, they are at the standard variable rate, which I said to you earlier was a scary thing, which is today around 8%. So 8% is what these people are paying. If they remortgaged, they would immediately get around 6% or even lower, because many of them would have paid out a big chunk of their house by now. A saving of 25 to 30% on your mortgage bill every single month. It's a no-brainer. So if you are watching this and you vaguely recall your parents or yourself even being on a HSBC Amana or Al Buraq mortgage, then get them to switch today. It will save you a lot of money. It is vital that you have a quick read of the terms and conditions, as there will be things in there that will surprise you or catch you out. For example, some banks don't allow you to pay extra repayments until 1 to 2 years have passed. That's important because if you know you're about to come into a lot of money and would like to repay a chunk of your mortgage in 6 months' time, but then you're not allowed to do that, then what you'll end up doing is paying more because you're not actually paying down your mortgage. Another important term is exit fees, if you have to exit or redeem your mortgage early. So in the case of StrideUp, you pay 2% of the entire finance amount if you exit within 1 year, and you pay 1% of the entire finance amount if you exit within the second year. And by exiting, it basically means selling your house. That for me has actually turned out to be quite a painful move, as I'm actually moving to Manchester this year, and so I hadn't fully factored that in. So keep that in mind as well. That's it for today, folks, on remortgaging. But please do check out our upcoming video on the Islamic mortgage market in the UK in 2024. Until next time, Assalamu alaikum.